Wells Fargo doesn't deny randomly. It denies those who don't understand how Wells Fargo evaluates risk. If you don't understand what Wells Fargo rewards, then you'll keep applying blindly. So today we're going to be covering credit access, business funding, even mortgage leverage. We're going to be discovering and unveiling how to leverage Wells Fargo to close the wealth gap if positioned properly. As of the time of this recording, Wells Fargo turned in revenues of nearly $84 billion in 2025. And the goal is to help you partner with institutions like this and build a relationship so you can actually get a piece of that pie. It's time to navigate these relationships so they are partnership and not an exploitation. So I'm going to be coming from my notes as I always do in these videos in this series, giving you the details that you need to master your relationship, access, and the growth potential with Wells Fargo. So I want you to take notes, pay attention. If you see me looking off, I'm just making sure I'm staying on point. And those of you who are familiar with the channel, you may have realized the last video I mentioned covering Bank of America, but because Bank of America was already covered in recent videos on some level, I decided to give it a break and cover a totally different institution. So the first thing we need to put back in context is, what are the stakes at play? We're all fighting against AI disruption. We're fighting against inflation. So it's time for us to understand how we can navigate the banking system so we can actually roll against these challenges in the financial system. So underwriting cycles tighten when these different disruptions come along and these economic cycles of volatility come along. Banks tighten, and many of us know that are out there in the field actively working with banks to try to up-level our financial position. When volatility arises, banks reward stability even more. So the wealth gap widens when people don't understand how to position themselves inside financial institutions, and that's the point of this series. So let's break down how Wells Fargo evaluates its clients, all right? Wells Fargo evaluates risk deep. Wells Fargo is conservative and relationship driven, which can be a benefit versus us covering Capital One that is extremely algorithmically driven, all right? So they evaluate across 5 lenses. Number 1, let's break this down. Deposit behavior, average daily balance, deposit consistency, payroll deposits versus irregular inflows, overdraft frequency. Overdraft hurts more than people realize. Predictability equals lendability. Overdraft is not predictability. It's not a good sign. The second is going to be credit stability. What does that look like? Revolving utilization, installment history, inquiry velocity, payment timing consistency. They prefer stable, controlled users, not optimizers who churn aggressively. Think about that for a second. For those of you who like to gather rewards points and go from one bank to another, capitalizing on bonuses, if you're looking to get outside of those benefits and really dive into the value of a financial institution, Wells Fargo does not play that churning game. So please keep that in mind. Number 3 is going to be relationship depth. Checking accounts alone does not equal relationship. Again, a checking account alone does not equal a relationship. So what does a strong profile look like? Checking, savings, credit card, possibly a mortgage or auto loan, business account if applicable, of course. Income profile, W-2 stability versus self-employed volatility. Now, this isn't a kick in the butt to those of you who are self-employed solopreneurs, but I encourage many of my business owners, you need to incorporate yourself if you're capable of it and put yourself on payroll, honestly speaking. Length of employment and industry risk, right? This is income profile. Again, W-2 stability versus self-employed volatility, length of employment, and industry risk. We're in a time right now where people are job hopping like crazy. I get it. Statistics and data is showing that, job hopping is where the pay raises come from. But those pay raises are minimal to the damage and the future opportunity cost you're costing yourself by hopping around every 6-9 year and a half. You need to get somewhere and stay stable as long as you can, even if it costs you a few $1,000s on a pay raise. Number 5 is time and tenure. 6 to 12 months seasoning changes everything with Wells Fargo. All right, let's take a look at what that means. Credit products that they offer. All right, specific leverage. Let's talk about the active cash. We know that that's going to be 2% unlimited, which is a great cash back card, what we would call a catch-all card. Prime positioning and stable earners. This is who's going to best qualify for this card. If we start to look at the autograph, that's a travel and lifestyle card. It's mid to prime tier borrowers. We got the Reflect. That's a 0% card. Good for balance stabilization. And then we have secure card options. All right. And this is where we start to talk about closing the wealth gap for those of you who need to build or rebuild credit. So it builds revolving profile, opens door to higher limit products, allows credit expansion without subprime lenders. I talk about that quite a bit on this channel. All of these sexy, cool, cute fintechs popping up, Chime, Self, all of that is cool. It can be helpful as a supplemental product. But just like a good diet, you can't supplement your way to health. You have to actually eat the food. In this case, a full-scale financial institution, fully credible financial institution, is the food. Self, Chime are examples of supplements, all right? So subprime lenders are not ideal if they're the only thing on your profile. You need the Wells Fargos, the Capital Ones, etc., the ones that are going to let you in the door to rebuild your credit or build it from scratch. So this is the strategy you need to go with when you're getting access to the credit that they have, all right? Keep utilization under 10% ideally. We all heard of the 30% situation. That's okay, but if you want prime results, under 10% is ideal. The next thing that's important, let it age. Please don't get it for 3 months and start moving around, shaking, turning, flipping, somersaulting. Let it age for a minute. Then request increases and graduate. Then request increases and graduate. So that's 6 to 12 months of letting them get a good gauge of your behavior and getting comfortable with you. And then work your way into graduating. I know the biggest problem with a lot of us is we want instant results, and the system has kind of tricked our minds into that. But I am doing my best to try to get you to understand that patience still pays off with these institutions. Let's talk about business funding on a deep dive level for a second. So we have different business checking options. What does that look like? The initiate, the navigate, and the optimize. That's going to be the 3 different business checking options. When we start looking at the various lending products available, we're looking at the Signify Business Cash. It's a credit card. Business lines of credit are available. SBA 7(a) loans are available. Equipment financing is also available with Wells Fargo. So you're going to have 0% options with them if you want to play that game with business credit cards. You can get into relatively, potentially low doc if you have your relationship with Wells Fargo, which we're going to talk about in a minute. Low doc business lines of credit. Of course, SBA is a full documentation program, but if you got your ducks in a row, 7(a) is tailored towards newer, smaller businesses. So that's another option. Equipment financing is going to be really good. Again, if your business actually needs equipment, a lot of people don't know that equipment financing can suffice really well for auto financing as well. You can oftentimes, if you can afford, if you can qualify for enough, you can often purchase a business vehicle and a business name using equipment finances at a lot of financial institutions. So underwriting focus, what does it look like to qualify for some of these things? What do we need to generally have in place? 12 to 24 months of revenue stability is extremely helpful. Deposit visibility, what does that mean? You need to bank within Wells Fargo. They're not the type of institution where you got a great credit score, but all of your banking relationships are outside. You're going to walk in cold with your 780, chest out with your briefcase, and drop down and expect them to qualify you for a line of credit out of the gate. Not going to happen. Deposit visibility is essential. Personal guarantor credit. Be ready for it. If you're not a really established 7-figure plus business, that has a track record and business credit for years, etc., provable financials, you will have to personally guarantor. Don't let these people out here have you thinking that you can get a couple U lines and Grangers and you can walk into a bank and get cash credit without a personal guarantor. Highly unlikely. Industry volatility. Let's talk NAICS codes. This is important as well. If you're going for business funding, you need to be mindful of your NAICS code or your NAICS code, tomato, NAICS code, North American Industry Classification System. This is a code that gives every bank and insurance company an opportunity to understand the industry you're in and the potential risk that can come with doing business with that industry. There are some industries that are just not attractive to banks and insurance companies. You don't want to lie. Let me be abundantly clear. You don't want to lie, but you want to be strategic. An example might be if you know you're in trucking, maybe you try to put this a little bit more under logistics. It looks a lot better than transportation to these banks and institutions. And you can do some of the research. Of course, you have AI and Google searches, but honestly, you can do some of the research by finding out what industries are considered high risk at this time. It's just all about how you phrase your questions when you're doing your research. But you can get an idea. Hey, like I'm Generally speaking, in the logistics transportation, is there one that's generally viewed more risky than the other? And that way you're not necessarily lying or stretching it, but you're still putting yourself in a position to look favorable in front of these banks. All right. So a key wealth insight I have for you: if business revenue isn't flowing through Wells Fargo, you look smaller than you are. If your revenue is not flowing through Wells Fargo, if your business, if your not main operating account isn't with Wells Fargo, then whatever you're doing, you might as well cut it down in half or maybe to a third, because you're just not going to look attractive. Capital access compounds. Without it, growth stalls. So if you're not putting your deposit through this financial institution, then you're limiting your access to capital, and limiting your access to capital stunts your growth. Very simple. So let's talk about how this institution can really dive into helping us close the wealth gap for ourselves, our family, our communities, and beyond. What does Wells Fargo offer in that department? Let's get into the weeds from a wealth gap perspective. So this is going to be a breakdown of 5 levers. All right. Lever number one, credit access and leverage. We have secured cards we covered, graduation pass. We talked a little bit about that. Relationship considerations. Very important. Credit, the ability to finance assets. Without revolving capacity, asset ownership slows. So in English, what that basically means is we want to get ourselves positioned credit-wise and relationship-wise where we can access capital effectively, because access to capital is the lifeblood to acquiring assets. Yes, you can save money and buy your house or buy your first rental property, but how many years is that going to take most of you? Versus getting maybe the down payment amount, 10, 15, 20%, and then putting yourself in position credit and relationship-wise to get a bank to give you the other 80 to 85 on favorable terms. That cuts your time down dramatically. And what does that mean? I can get to another property and another property. If it took me 5 years to save for one property versus maybe 1 or 2 years to save for a down payment and build a strong relationship, that means I'm 5xing, 3xing, 5xing my wealth accumulation. Does that make sense? The faster I can access capital strategic on good terms, the faster I can get my hands on more assets versus me waiting and missing out on all that equity growth, all of that cash flow from waiting 5 years to save up for cash on that property. Just something to think about, especially if you're not a dramatically high income earner. Next, lever number 2, business capital. Scaling SBA programs matters. SBA allows lower down payments, longer amortization, lower documentation threshold than traditional commercial lending. That means entrepreneurs with moderate resources can scale. Scaling business ownership narrows the wealth gap. So Wells Fargo, being an SBA lender, when you position your relationship with them, then you're positioning yourself in a better position to qualify for the SBA. The SBA has the best terms on business funding you're going to find in the marketplace. They are not always the most accessible, and that's why everybody's not turning to them. But if you get your ducks in a row, they can have the best terms, down payment requirements, and flexible documentation needs to an extent if you're a newer business looking at like a 780 situation. So Wells Fargo can help you close the wealth gap by developing that relationship and walking you strategically into the position you need to be to qualify for business funding on the commercial side as well as the SBA side. That capital helps you scale your existing business or solopreneurship and close the wealth gap. Lever number 3, mortgages and home ownership. Wells Fargo offers conventional, FHA, VA, community lending programs. This is where it gets interesting. Down payment assistance, location dependent, of course. So community lending, let's talk about that for a quick second. That's going to be lending that is dedicated to serve specific communities. That means you may have flexible underwriting, lower down payment, or lower documentation requirements. Doesn't mean they're going to give you the loan, but it does mean that they're not going to try to hit you to the same standards as somebody who comes from a better off community and has things better laid out for them. So if you're in a situation where your credit isn't quite ideal, you don't have all of the documentation in place you need, you're just having a hard time saving cash, you have a good income, a good job, credit's all right, but you're having a damn hard time saving down payment money, community lending steps in that arena, and Wells Fargo offers that. A lot of times the wealth gap is a home ownership gap. Bookmark that I said that. A lot of times the wealth gap is a home ownership gap. People keep criticizing home ownership as an asset class or not. We have these rich dudes running on YouTube and on social media constantly talking about how home ownership isn't an asset. And yet there's direct correlation in statistics constantly proving that for middle class, working class America in particular, the wealth gap is broadly determined by home ownership rates. They're almost synonymous to each other in a lot of cases, or not far off. It's not an accident. It's not a coincidence. So underwriting looks like on the mortgage side, they're looking at DTI, income consistency, asset seasoning. If you do qualify for one of these lending programs, you might need to have reserves. And that includes having a 401k or an IRA that has that. It doesn't have to be in cash, but it does need to be established with adequate reserves in it. Deposit stability. We talked about overdraft. We talked about having consistent inflows. So home equity compounds. Rent does not. Keep that in mind. When these rich dudes who own a bunch of rental properties that they want you to rent at some point tell you that home ownership isn't a wealth building tool or isn't an asset, keep in mind home equity compounds and rent doesn't. This is a real wealth transfer mechanism. Keep that in mind. Lever number 4, wealth services, brokerage assets, advisory services, investment accounts. So assets inside the bank. We're talking about stock portfolios. We're talking about having that money managed for you, wealth services to help you with legacy planning, retirement planning. All of this is available at Wells Fargo for sure. So strengthen your relationship depth, improve perception, increase cross-product leverage. Money parked outside the system doesn't build internal leverage. Stop hiding your money. Stop trying to duck and dodge the system. Let these banks see what you're doing right so you can use it as leverage to get access to the tools you need from them to grow. So, lever number 5, behavioral discipline. Wealth gap isn't just income gap. It's a behavior gap. The wealth gap is not just an income gap. It's a behavior gap, tremendously so. What does that look like? We want to avoid overdrafts. That's a behavior issue. We want to avoid volatile balances. That's a behavior issue. We want to avoid short-term credit plays, stabilize over flash. Stability, over flash. What that basically means is stable and consistent over flash results, churning and burning. That's all behavior. And if you want long-term success in this system, these are the consistency mechanisms you need to exercise in the bank's eyes. So what is the 12-month position and blueprint if you were my client and I were advising you? All right. Month 1 to 3, take notes, pay attention. Open a checking account, set up payroll direct deposit, ideal form of payment, build an emergency fund of liquidity. That's your first 3 months. Open a checking account, set up your direct deposit, build an emergency fund for liquidity. 3 to 6 months, add 1 credit product. 1, not 4. 1. I don't care if they got double dips and triple dips. 1. Keep utilization under 10% from that credit product. Easygoing behavior. 6 to 9 months. Now we're starting to mature. Add savings or a brokerage account. Build the savings up beyond your emergency fund and build the liquidity, or start to invest with Wells Fargo. Maintain stability. Everything you've built from month 1 to month 9, maintain it. Month 9 to 12, now we cooking. Apply for higher limit cards or a line position before you request, and then line up position, before you request. So apply for a higher limit card or a higher limit on your existing card. Make sure all your ducks in a row before you apply. So here's something for you to think about. You don't fight banks. You don't fight banks. You position inside of them. Very important. Banks reward stability, profitability, predictability. Get it tattooed on you. You want to be wealthy in this system, get that tattooed on you. Banks reward stability, profitability, and predictability. If you understand that, the wealth gap becomes navigable significantly. You stop swimming upstream and you flow with the current. Very important. So Wells Fargo isn't perfect, but it can be a powerful tool. on our journey to closing the wealth gap and building our net worth. Very powerful tool. This is a series about turning institutions into leverage. The next bank is going to be a different culture with different rules. So make sure you're tuned in. To all my pioneers, welcome back. To my new viewers, welcome in. Like, comment, share, subscribe. When it gives you the option, boost the video. Support the channel so the channel can continue to support you. I want you to get in the description section down below. Time with me on Instagram and TikTok. Also, for all of you who are new, who stuck it out and got all the value in this video, shout out to you. I am a career banker by trade. If you're curious where I'm getting all this information from, I'm a banker by trade, financial services professional, 14 plus years in the field. I work with consumers and small businesses, and I've been working with them to the tune of $25 million in deposit relationships per year, 50 million nearly in investments per year, and 7 to 8 figures in lending relationships per year basis. So some of these people leave in and out of my books. Some of them stay. It depends. So I'm dealing with a very significant clientele base as I bring you this information. And the same info I'm bringing to you is what I bring to my consumer and small business clients to help them grow their revenues and to increase their net worth as well. So I want you to keep lock in, subscribe, support the video, support the channel so I can continue to bring you the same insights so you can continue to grow as well. Other than that, I want each and every one of you to stay focused, stay in motion. I'll see y'all soon.